Get your free copy of the complete tutorial at www.teachucomp.com/free. When companies have large amounts of inventory, it's important for them to account for it properly. Fifo and Lifo are systems of accounting for the value of inventory within a company. Fifo stands for first in, first out, while Lifo stands for last in, first out. It is important that a company understands which system is best to use and how to correctly use each system. Incorrect use of an accounting system can severely hurt the company or make it difficult for users to understand the inventory accounting and inventory costs. Let's first take a look at FIFO. Remember that FIFO stands for first in, first out. This means that the goods that are first in, or the earliest goods purchased, are the first ones moved out of inventory or sold. FIFO parallels the actual physical flow of merchandise because it is generally good business practice to sell the oldest units of goods first. Understand that under the FIFO method, the costs of the earliest goods purchased are the first to be recognized when determining the costs of goods sold, regardless of what units were actually sold. Let's take a look at an example to get a better understanding. This chart shows the inventory purchases for company XYZ. It also shows the total cost of all inventory purchases for this specific period. After determining the total cost of goods purchased, we need to calculate the ending inventory value. Since we are using the FIFO method, the goods last in will still be held in inventory. For example, we will say that the units from the August 25th purchase, the $1,000 and 100 units, is the ending inventory. In real life, companies would use real inventory counting instead of just guessing, but for our example, we will say that all of the units purchased from January 1st and March 3rd have been sold, and the August 25th merchandise is still in inventory. The next step is to take the total cost of goods available for sale, $6,300, and subtract the ending inventory, $1,000. We are left with $5,300, which is the cost of goods sold. This is a method for accounting for the inventory. Let's take a look at LIFO. Recall that LIFO stands for last in, first out. This means that the goods that are last in, or the latest goods purchased, are the first ones moved out of inventory or sold. Using LIFO, companies obtain the value of the ending inventory on hand by taking the unit cost of the earliest goods available for sale and working forward until all units of inventory have been accounted for. Using the same data as the previous example, we will calculate the cost of goods sold using the LIFO method. Once again, this chart shows the inventory purchases for Company XYZ Inc., and it shows the total cost of all inventory purchases for the specific period. After determining the total cost of goods purchased, we need to figure out the ending inventory. Since we are using the LIFO method, the most recent goods purchased are the first ones out. So for this example, we will say that the units from the January 1st purchase, $2,000 and 200 units, is the ending inventory. Remember that in real life, we would actually account for the inventory to determine what is left in inventory. But to make it simple for our example, we are just assuming that the January 1st purchases is the ending inventory. The next step is to take the total cost of goods available for sale, $6,300, and subtract the ending inventory, $2,000, and we are left with $4,300, which is the cost of goods sold. Like what you see? Pick up your free copy of the complete tutorial at www.teachucomp.com/free.